what we're going to be going over here is governmental accounting for revenues as property taxes and any associated tax liens that would go against that property. Okay, so let's start out with levied property tax revenues. Now in governmental accounting, this is where you're going to use the modified accrual system to accrue any revenues here. And this is where you cannot accrue revenue unless it's available and measurable. So for our levied property taxes here, it would be available and measurable when the tax notices are sent out to the property owners telling them how much taxes they owe on their property. So this, again, when the taxes are levied, it's available and measurable, and then you can go in and you can accrue the expected amount to be received at the time that those tax bills are sent out. So let's look at the accounts that we're going to have to deal with here. Of course, we're going to have our cash account, and we're going to be looking at it in terms of the general fund receiving these tax revenues here. And then we're going to have our receivables here, and look at the title that we're showing here. I'm showing it in T-account form. This is where we're going to have property taxes receivable labeled as the current amount here, and that's going to be for our levied property taxes here. And then we have to set up an allowance for uncollectible property taxes here as a contra account to our property taxes receivable. And then along with that, we're going to have our revenue control account here for the expected or the revenues that we're going to inflow to the business or to the city or the governmental unit here for any of those tax dollars collected, again for the general fund account. So what we're going to look at here is we're going to be concentrating on this revenue control account here. So you can only initially here accrue the expected amount to be received here. We're going to be looking at that. And then we're going to have to make any adjustments for the actual amount received on these tax collections, on this property tax collection. So let's start with our case here where we're going to levy a real estate tax of $500,000, and along with that we estimate that there's going to be an uncollectible amount here of $20,000 here of the $500,000 real estate tax levied. So let's look at our entries here. So starting out with our property taxes receivable, again the current portion here, we would debit that here for the $500,000 worth of taxes that are levied here. And then along with that, we have to set up our allowance for uncollectible property taxes. We're estimating that to be $20,000 here. So credit that here for $20,000. It's a contra account to the property tax receivable, or it would be reducing our property taxes receivable. And then moving over to our revenue account, it would be our revenue control, again for the general fund. We would credit that here for $480,000. That's the expected, again, we can only accrue the expected amount to be received here, $480,000. We're going to levy $500,000. We're saying that $20,000 of that $500,000 here, are estimating that $20,000 won't be collected, so we can only accrue $480,000 here. All right, so what we want to look at here is A here, where the uncollectible taxes are really a reduction to revenue here. So whatever we set up here in our allowance for uncollectible property taxes, in this case is $20,000, it is a reduction to the revenue here. We're sending out $500,000 worth of tax notices here, but because we have the allowance here for uncollectibles set at $20,000, we can only accrue or expect to receive here $480,000 worth of tax dollars. Okay, so now let's go and let's look at the case here where the actual collection is actually $492,000. So what we want to do here is we have to, first off, our property taxes receivable, since we actually collected $492,000 here, we credit or reduce our property taxes receivable by that amount, and then of course we would have received or debited or increased our cash account here in the general fund here for $492,000. So that's the actual amount that we received. Now, because we had accrued here, going back to our revenue control account, because we had accrued here only $480,000 initially when those taxes were levied here, we're going to have to make some adjustments to the allowance for our uncollectible property taxes and also our revenue control account here. So what we would do in this case, you can see here, well, we received $492,000 here of the $500,000 that was levied, so that would left us with $8,000 uncollectible taxes here. So we initially set it at $20,000. We're now down to $8,000 uncollectible since we collected $492,000 of the $500,000. So our adjustment goes to our allowance for uncollectible here. Well, $20,000. To get down to $8,000, you'd have to have $20,000 here less $12,000. We had credited here initially our allowance at $20,000. Now we have to reduce it such that we get down to a total allowance here of uncollectible property taxes of $8,000. So that would be a credit or debit here, reducing our allowance for uncollectible by $12,000. And then our credit is going to go to revenues control here for $12,000. That's going to bring us up to the total amount here, $492,000 collected. The $480,000 here, the initial amount that we estimated we're going to be expected to collect here, and then that adjustment that we have here for the actual adjustment for the actual amount received here of $492,000. So we get the $480,000 plus the $12,000 brings us up to $492,000. So let's go and let's just look at our logic here, just because it's very simple here, just looking at the numbers, how we had to make our balancing amounts between our allowance for uncollectibles here and our revenue controls. But let's look at it here. Now this is the case here. If the allowance amount is initially overstated, which it was in this case at $20,000 here, you reduce it with an offsetting increase to the revenue account here. Of course, the opposite is true if the allowance is understated, but you can see just so you can see what's going on here, was initially overstated here at $20,000 by $12,000 because we only determined at the end here we only had an uncollectible amount here of $8,000. So the offsetting entry here, your allowance for uncollectible in this case, we would have debited it here for $12,000, and then the associating offsetting amount would go to credit to the actual revenue control account here for $12,000. So everything balances out here. You see, we started out, you have to determine your initial amount that you expect to receive here when you levy those property taxes, and then you have to make any adjustments for the actual amount received here. So in this case, we actually received more than we initially expected to receive here by $12,000. So what we did here in our allowance for uncollectible accounts, we had to reduce it here, debit it here by $12,000. Initial amount here was $20,000, and then our debit here for allowance uncollectible, the credit had to go to the revenue control account. Okay, so that's basically what we're working with here when we're looking at governmental accounting here for, in this case, accruing property taxes. And now remember, if you were working with for-profit companies, it would be different here. The entire amount of revenue that you're expecting here for the period would have been set up here. You would have recognized that entire amount of revenue, but then you would have had some bad debt expense reducing that amount of revenue here on an income statement basis here. But for government accounting, you only actually, you can accrue whatever you expect to receive here for those tax dollars when you, in this case of the levied property tax dollars, you can only accrue it for the expected amount to be received, not the actual amount. And instead of a bad debt expense, you set up an allowance to uncollectible, in this case, your allowance for uncollectible property taxes, which is a contra account to in our property taxes receivable account. So that's how it works here when you're dealing with governmental accounting for revenues as property taxes. Here we're going to be looking at collections on delinquent property taxes, where the balance after our collection here in those delinquent property taxes is going to be transferred to a tax liens receivable. Okay, so what are we talking about here? Now, what I want you to look at here are those account names. So we're going to have here this, and I'm showing it in T-account form here. We're going to have some property taxes receivable classified here as delinquent taxes, and along with that a receivable account here, we're going to set up an allowance for uncollectible delinquent taxes, which is a contra account to our property taxes receivable account. Okay, and what we're going to do here is we're going to receive, we're going to have some collections here on those property taxes receivable here, and what we have after those collections here, whatever the remaining balance is, it's going to be transferred into tax liens receivable for delinquent taxes, and along with that tax liens receivable, we're going to have set up an allowance for uncollectible delinquent tax liens here. Okay, so let's look at our example here. And we're going to start out with the case here. We're going to have a beginning balance in our property tax receivable here of $135,000. In our beginning balance, we're going to have in our allowance for uncollectible delinquent taxes here at $40,000. Now, just a note here, those amounts would be carried over from any previous period here, and they would have to been previously reclassified as delinquent taxes. So we're just going to start with those beginning balances here. So let's look at the first case here where we're going to have delinquent tax collections of $100,000 along with interest collected on the tax here for that $100,000 of $4,500. So what do we want to go down to? Our property taxes receivable account here, delinquent taxes. We're going to credit that here for that $100,000 collected. So that's going to be a reduction to the $135,000 here that we had in our beginning balance, and then what we actually collect here in cash, and just looking at it again in a general fund, this is cash going into our general fund, we would have debited that here for $104,500. That included the $100,000 collected here plus $4,500 of interest collected with it. So we've got our debit here in our cash account for $104,500. We got the credit here in our property taxes receivable, $100,000. So we need another credit balance here, and that's going to go to the interest earned here on those taxes receivable or delinquent taxes receivable of $4,500. Okay, so that takes care of reducing our property taxes by $100,000 here along with that interest. So now we're sitting here and we're saying the remaining balance in our property taxes receivable here, delinquent taxes, is going to be transferred over to our tax liens here. So looking at what was our remaining balance here, we have here we have remaining balance here is going to tax liens. We have $135,000. We reduced it by $100,000 here for the receipts on those property taxes here. So we're sitting with $35,000 remaining in our account. So to zero it out here, we would credit our property taxes receivable for delinquent taxes by $35,000, and then the balance or the debit would go into our tax liens receivable for delinquent taxes. So we just reclassified this as now we got a lien on the property here, so we're going to have to set it into a different account here called tax liens receivable, delinquent taxes, debit that here for $35,000. Now we have to deal with our allowance for uncollectible, that was our contra here to our property taxes receivable for those delinquent taxes. Now remember, we had a beginning balance here of $40,000. Now the case is we want to transfer that allowance uncollectible delinquent taxes into the uncollectible delinquent tax liens account. So what you would do here, this is critical here. We got the $40,000 here, so we're going to debit out the entire $40,000 for those uncollectibles. So we've taken, we don't have any property taxes receivable here, zero balance, and also our allowance for uncollectibles is going to be sitting at a zero balance. But if we move the entire $40,000 into our allowance for uncollectible delinquent tax liens, that we can't do because we only have $35,000 sitting in our tax liens receivable here account here of $35,000. So our contra account can't exceed that amount here. So we can only take and credit or increase our allowance for uncollectible delinquent tax liens here by $35,000. So what we have to do, our transfer is the maximum we have allowed here, $35,000. So the balance is going to go to revenue. $40,000 here that we're transferring out of the delinquent taxes here, and $35,000 is going into our tax lien account here, allowance account here. So we got that $5,000 to deal with here. So that $5,000 is going to go into revenue control for property taxes here. Credit it for $5,000. So you can see what's going. The critical thing in this problem here is when you've transferred from your delinquent taxes to delinquent taxes with tax liens here, you have to make sure that any allowance for these any allowance here that's transferred over can't exceed whatever tax liens receivable you have for, again, those delinquent taxes here. Tax liens here. So you got to make sure that you're making everything as falling in line here. You can't, your allowance for those uncollectibles can't exceed whatever tax liens you have for the receivable. So that'll about what you have to be looking at here when you make those for making your collections here. Just remember, in this case, we had that interest here. We had to include that into our revenue control here based on the actual cash collected here. And then when we zeroed out or we transferred our property taxes receivable, we also, for the delinquent taxes, we also had to transfer out our allowance for those uncollectible delinquent taxes here to those tax liens for our receivable, and also the allowance for those tax liens receivable. Now let's look at tax liens collected and a property settlement on tax liens. That is, we're going to have sold the property here to settle the tax liens that we have. So, and this is the case here, we're going to, on the sale of this property here that we have a tax lien against, we're going to close out our tax liens receivable and any allowance account for our tax liens that we currently have. So this is what we're going to be looking at here. We're going to have a tax liens receivable for delinquent taxes, and we're going to have a beginning balance, let's just say for example here, of $45,000, debit a balance here, $45,000 in our receivables here, and then we have, along with that tax liens receivable, we have an allowance for uncollectible tax liens. And for example, we're going to have a beginning balance here, a credit amount here of $23,000. So the first thing that happens here is that our tax liens, we're going to have collected $12,000 worth of those tax liens. And along with it, we're going to have collected some interest here of $2,000. Okay, so what we would go here to our tax liens receivable, again, delinquent taxes, credit it, reduce it here by $12,000 for the collection here, and then we have that interest that we're going to have to account for. So going over to our cash account, we would have debited or increased our cash account here for $14,000. That would be the $12,000 collected on the receivables plus the $2,000 on the interest here. So the $2,000 ends up in the revenue control account here for property taxes. We credit that here for $2,000. Okay, so now what we're going to do here is we're going to have the balance in our tax liens account here, $45,000 here, less the $12,000 we already collected here, so we have a balance of $33,000. Now this $33,000 balance, we're going to settle it by receiving property here that we're going to receive we're going to sell the property on this settlement, the $33,000 worth of tax liens receivable. We're going to sell the property and receive $16,000 in cash. So that property was subject to the liens here. So going down to our receivables here for our tax liens, we credit that here, reduce it by $16,000, the amount that we received here in cash. So, and then we'd reduce tax liens receivable by $16,000, and then the cash account would have been debited or increased here by $16,000. So that is the collection here of the remaining tax liens for the sale of the property. We received $16,000, but remember we had a balance sitting in $33,000. So what we're going to do now that we've sold the property, we have no more tax liens receivable or any lien against any property here. We're going to have to close out our tax liens receivable account and also our allowance for those uncollectible tax liens. So what are we sitting here in the account? We have the $45,000 beginning balance. We received $12,000 here on the collections, and then we have $16,000 here on the sale of the property here with the liens. So net amount that's sitting here in the tax liens receivable here is $17,000. So that our tax lien receivable has to now be closed out. So we'd credit that here for the amount that's the remaining balance here of $17,000, and at the same time we have to, our allowance for uncollectible tax liens, that has to be closed out as well. So we had the credit amount here, $23,000 beginning balance, so now we debit out the entire $23,000 amount here. So we've got an imbalance here between our tax liens here of $17,000. Our balance was less here than our allowance and our allowance for uncollectibles for those tax liens of $23,000. So let's look at where that's going to go. That's going to go into our revenue control, or we're going to credit or increase our revenue control by $6,000. So we have $23,000 here in our allowance account, and then the difference we have $17,000 here in our tax liens receivable delinquent tax account here, $17,000. So we have $6,000 here. So that balance is going to go to revenue here. So we're going to actually increase our revenue here by $6,000. Okay, so that's how we would be working here with a tax liens receivable and an allowance for the uncollectible tax liens when we have to close it out here based on the fact that we're making a settlement here on some tax liens. We made the settlement here by whatever was sitting in our balance here. Well, we had $33,000 in our balance on tax liens, and we settled it for $16,000 here on property we received, and that $16,000 was the cash receipts on those properties. And then remember, we had to close it out here. Whatever balance was sitting in our tax liens receivable, we had to close that out, and we also had to close out any allowance for uncollectible tax liens that we had against our receivables. We had to close that out because there was an imbalance. In this case, our receivables were less than our allowance for uncollectibles. Therefore, we had an increase in our revenue here, in this case by $6,000. Now let's look at the case here where the city government or the municipality is going to need some cash here, and they're going to issue a notes payable to generate this cash, and it's going to be based on current property taxes that they have receivable, and these current property taxes are not yet collected, and they're going to use them as collateral. So the first thing they're going to do here is they're going to go out and they're going to borrow some money through a notes payable, and it has to be titled here tax and anticipation notes payable. So to record the borrowing for the notes payable, you have to include the description here as a tax and anticipation for the notes payable. So let's say we need $275,000. So credit or increase your notes payable here as a tax anticipation. Again, a liability here for $275,000, and then the cash you would debit or increase your cash here for $275,000 on the notes payable that you received here. And then let's just say when you come to pay off this notes payable, you'd pay, in this case, the $275,000 with interest. Let's say there was $18,000 charged on interest in that notes payable. So you go down to your notes payable account here, debit it or for $275,000 to close it out here, and then your cash account, in this case, you're going to have to reduce your cash here by $293,000. The notes payable amount of $275,000 plus the $18,000 worth of interest expense here. So that would be equals to the $293,000. So the balance would have to go into expenditures control for the notes payable interest. You would debit that here for $18,000 for the interest expense. So that's how you would take care of some short-term borrowing here through a notes payable to generate some cash that you need, and that would be based on some current property tax that is not yet collected.